If you work in finance or accounting and want to land that next promotion, then you better listen up. I'm sharing 5 incredibly powerful techniques for financial analysis that will absolutely impress your boss and help you land that next role. I'm Mike, and for over a decade, I've worked in finance at companies from the Fortune 100 all the way to brand new startups. Over that time, I've done more than 140 reporting cycles and more ad hoc analysis than you could possibly count. I have seen some incredible analysis that blew my mind, and I've seen some incredibly horrible analysis that blew my mind in a different way. I've watched analysts dig into the business and discover growth opportunities that marketing, operations, and even business development missed. I've also watched analysts read variances off every line of an income statement as if the variance itself was the analysis. I want to make sure that you look like the first group and definitely not the second. Make sure to stick around to the end because I'm going to share with you a free tool I built that others are charging $50 or even $100 for, and it will be yours completely free. And if you're new here, hit that subscribe button and ring the bell so you never miss out on our weekly finance hacks and insider tips. I post a new video every Monday. And trust me, you do not want to miss what we have coming up next week. So with that said, let's get into it. Here are my 5 powerful techniques for financial analysis. So let's talk about what we're going to cover in this example. First, we're going to talk about trend analysis. Second, we're going to talk about ratio analysis. Third, we'll go through horizontal and vertical analysis. Fourth, we'll look at rate volume mix analysis. And fifth, we will look at benchmarking. Now, I could put up a PowerPoint presentation and walk you through all of these line by line, but what I actually want to do is take you through a live financial analysis with real details from the real world so we can better understand this all together. On the screen, you'll see I have an Excel workbook open. In this Excel workbook, I have the 2023 financial statements from 2 competitors. The first is AT&T and the second is T-Mobile. Now, I do know these companies quite well because I cover them for Seeking Alpha, but I haven't looked at these financial statements specifically. What I wanted to do was take you through a live example of how I'll use these tools to go through the books, knowing how the company works, knowing how the company functions in its business, but not having seen these numbers. That's just how you'll encounter it in the real world. You know how your business works, you know what your company needs, but you don't necessarily know exactly what the numbers will look like. So I wanted to make this as real as possible, and we're going to go through this together. So the first thing I want to look at is some trend analysis. Trend analysis is simply looking at historical data to look for items that are either on the trend or off the trend. If they're on the trend, we can use that to kind of extrapolate our future performance or understand that the business is where it needs to be. If it's off the trend, we can really dig into that and understand what happened, whether it's good or it's bad. We can learn from the good, we can improve upon the bad, and go from there. So what I'm going to do is I'm going to add a new tab where we'll start working on our trend analysis. We always want to keep this organized, so we'll call this trend analysis. And a little tip I like to do, I like to separate my tabs so that I know where everything is. So we're going to call this data over here. We'll make this a different color by going to tab color. I'm going to then copy this and I'm going to do another one for my analysis. It is always important to take the extra couple of seconds to make sure that you're keeping your workbook organized. Great. So now in trend analysis, let's go in and pull in the headers for the last 2 years. They're already here, no reason to rebuild them. And make sure to note this is 2021. We just want to look at this year. So we'll come back here and we'll paste that in here. I'm just going to leave their formatting for now. No big deal. So then what do we want to look at? Well, let's say we want to look at revenue, expenses, and profit. They call it operating income, but I'm just going to call it profit for now. All right. And here's our numbers. So there's our revenue, there's our operating expenses, and there's our net income. So we're just going to link these all up. There's our revenue. There's our operating expenses. And there's our net income. We'll drag these over. And we'll do a little bit of formatting. Okay, so now what I want to do is I'm just going to put this on a chart because I want to be able to look at the trend visually. It's not quite as easy to look at the numbers. So I'm going to go to Insert. I'm going to insert a line chart. All right, and there's our revenue, expenses, and profit charted out for us. So now here's the really cool thing that you can do with this. You can put trend lines in to really look for where things are on or off the trend. So first I'm going to click on the top line, which is our revenue line. I'm going to add a trend line. There's our trend line. I'm going to come down to expenses. I'm going to do the same thing. Add a trend line. And I'm going to go to profit and add a trend line. We'll make that a little bit bigger so it's easier to see. So what you're going to see is that if it's above the trend line, that means that the business overperformed in that period. And if it's under the trend line, the business underperformed. So we see that in Q3 2022, profit fell significantly below the trend line. And that was driven by both a decrease in revenue and an increase in expenses. Now, if you're the analyst in the company, this is where you want to go and start explaining why did the revenue come down, why did the expenses come up, and how can we prevent that from happening in the future? Because you'll see future performance, it looks like they did catch it, they did rebound, and then they went above the trend for 2023. So that's how trend analysis looks. We look at historical data, we look for things that don't make sense and aren't on the trend, and then we dig into those variances and come back with kind of robust explanations for what happened. Next up, we want to look at ratio analysis. There's a lot of ratios that are very commonly used. We're going to look at 3 of them today. The first is going to be the current ratio, which evaluates the strength of your company's current assets relative to your current liabilities. Just understand how things are in the immediate future. We're going to look at gross margin over time, which is how your revenue and your cost of goods sold compares. And then we're going to look at debt to equity, which is an understanding kind of just how leveraged you are versus what's invested into the company. So we're going to again look at this for T-Mobile. We're going to go in, we'll build a new tab, just like we did for trend analysis. Again, it's always important to keep organized in our formatting. So we'll put this over here. We'll call this ratio analysis. And let's put in the calculations. So this will be the current ratio. For the current ratio, we need current assets, current liabilities. There's the ratio. Then we need gross margin. For that, we need revenue, cost of goods sold. And for debt to equity, we need our debt and our equity. And for these two, I forgot to put in a ratio line. We'll pop that in real quick. There's that, there's that. And we'll go back over here. Just copy our period since we've already done that. There we go. And we'll quickly format that, double click to widen. And now let's go get the information we need. So assets and liabilities will be on the balance sheet. Let's go over to the balance sheet. Here's our current assets. Here's our current liabilities. Gross margin, we need our revenue. That'll be on the income statement. There's our revenue. And these two lines are both our costs, so we're going to want to sum that. All right, so we'll pull those together. And then I want to go back to the balance sheet to get our debt. There's our long-term debt right there. And we'll get our equity. And there's our stockholders' equity, total stockholders' equity right there. All right, now let's pop in our ratios. So this ratio is current assets divided by current liabilities. Gross margin is cost of sales divided by revenue. And debt to equity is the amount of debt divided by the amount of equity. Again, always like to clean everything up, so we'll do some quick formatting. Always format as you go, so much easier. These are typically displayed as percentages. And we'll drag it over and clean up the formatting. And there you go. So there's a ratio analysis. Then we'll look across and see kind of what's going on. We see back to that same period that we were having profitability challenges, that the current ratio went to 104% and then fell kind of down to the low 70s. So we'd want to investigate what happened there. We see that gross margin has actually deteriorated over time. We started at 48 to 46%, and now we're down to the mid 30s. So we want to investigate why our cost of sales is changing so significantly. And then on the debt to equity standpoint, you'll see that debt has really started to come up relative to equity. Likely, knowing the industry, that's related to some Spectrum purchases. Won't get into that, but that's what we would want to kind of dig into there and understand what's happening. So now we're going to talk about horizontal analysis and vertical analysis. Horizontal analysis is going to be really easy to cover because horizontal analysis is just another name for trend analysis. You'll hear it called horizontal analysis a lot in accounting. It's exactly the same thing as trend analysis, which you can refer back to earlier in the video. So with that, we'll focus our example on vertical analysis. So where horizontal or trend analysis looks back across time periods, vertical analysis looks within a specific period to understand the composition of revenue and expenses or other items through that period, and then we can kind of compare that across periods. So we'll do that now. What we want to do is we're going to look at T-Mobile's income and expense breakdown at the end of 22 and at the end of 23. So for that, I'm going to pull in all of the lines from revenue down to net income. We'll create a new tab, continuing to stay as organized as we possibly can, and we'll call this vertical analysis. All right, then we're going to pop in the accounts. Oh, I lost the accounts there. Let's go back and grab them. There's the accounts. All right, we will widen that out. And then we will grab the time periods. There we go. And we'll link it all up so we can pull in our data. So now that we have our data pulled in, we want to look at the composition. Usually we do this against revenue. So we try to benchmark against total revenue and see what the composition is. So we're going to want to link everything up to a factor of our revenue. Note the total revenue is actually down here. It's not on top, so we're going to want to jump past that. And we're going to want to lock down C9 so that doesn't change. So now what this is going to do is it's going to give us all of our values in proportion to the revenue all the way down to our net income. All right, so there's that. And then we're going to come over here. We're going to do that divided by total revenue. We're going to lock that in. And there you go. So now we can look to see if anything has changed substantially over time. So we'll see that our equipment revenue has come down, but postpaid revenue went up. Cost of services went down, while cost of equipment sales stayed roughly the same. Our SG&A costs came down. That's always great to see. For a total reduction in operating expenses that flowed right through to the bottom line. And then just a couple of small changes below, but really that cost savings has flowed all the way down to net income. And then we can dig into that to kind of build a story around how we drove the cost down, how we maintained revenue growth, and that becomes the analysis. So that's vertical analysis, benchmarking everything against a certain line on the P&L or balance sheet. In this case, it's total revenue, and then seeing if any of those changed from one period to another. So now before we get into our next analysis technique, which is rate volume mix, I want to share with you this special bonus. I've built a calculator to help you calculate rate, volume, and mix because the calculations aren't that complicated, but they're also not that straightforward, and it's a little tough to get it right consistently. So I put together a calculator. I've seen other websites selling these calculators for $50, $100. I just want to give it to you free because this is just an Excel spreadsheet, and this didn't really cost me much to build. I just want to help you out and make sure this supports it. So I'm going to walk you through this analysis using the rate volume mix template, and then at the end of the video, down in the comments, you'll find a pinned comment where we're going to have a link right to get this downloadable template for you. You can take it, use it for any of your business needs, whatever you want to do. So I've got the rate volume mix template set up in another tab. What's important to remember is that all of the cells highlighted in green, these are cells where you'll need to put in data. Everything else is a formula. You don't want to touch that. It'll calc automatically. So I'm just going to pop this over into our other file. We're going to create a copy of this. We'll make sure to put it in our analysis section. And there we go. Now the rate volume mix has been copied over. So now that we have the template formatted, we're going to load in all of our data. So this first line, this is going to be our postpaid, and the second line is going to be our prepaid. The first thing we want to do is load in our units. So in this case, those would be our connections. Actual will be the current period. We'll drag that down. And prior year will, of course, be the prior year. So we'll go back to 2022. Postpaid and prepaid. So now that we've got the units in, we want to go get our rate. You'll see that the mix actually did not change at all, so that won't be much of a factor here. That's a situation where, it is beneficial sometimes to look ahead of the financials, because I would like to see a mix calculation different, but this is why we go through it live. There just is no mix calculation, and sometimes that's going to happen. So we're going to come back over here. We're going to go down and get our rate. So here's our postpaid and prepaid for the current year. And here's our postpaid and prepaid. All right. There we go. So now that we've loaded all of the green cells in our template, all of the work is done for us. So looking at the variance of the 158,000, our biggest story was volume. We actually drove additional connections and units through volume. The opposite was true on prepaid, down 3,000. Now, little tip on the telecom industry, postpaid is a lot more valuable than prepaid. So this isn't necessarily a bad thing because our net volume is up. That's why it's important to both look at the individual lines, but also step back. As a telecom company, I much prefer the rate, and you'll see that postpaid is more valuable looking at the rate because our volume was up. We also got rate. Now, some of that could have been on the type of accounts people were choosing. There's a lot of different factors, but volume and rate were up, so we don't really care that prepaid was down. That's actually a pretty good trade-off for us. And then you want to dig in further to this, and you can use this across anything. You can use this for cost of goods sold. You can use this for anything where there's a rate, volume, and mix component, and this calculator will work just great. And our last financial analysis technique is benchmarking. Now, this can either be benchmarking within your company to understand how different things are comparing to each other, or you can look at different companies. So what we're going to do now is look at how T-Mobile's rates compare with AT&T's rates to understand if there's anything we can learn about our competition. So again, we'll add a new sheet. We're going to call this sheet benchmarking, and then we're going to go in and pull in some detail. So I'm going to pull in the time periods. All right, and then I want to look at AT&T postpaid, T-Mobile postpaid, AT&T prepaid, and T-Mobile prepaid, and we want to understand how our rates are different, and that's going to be our benchmarking. So let's go grab our AT&T prepaid rates. There's our AT&T postpaid rates rather, and then we're going to do our AT&T prepaid rates down here. All right, and then we'll go grab our T-Mobile rates. All right, we're going to just scroll down. There's our postpaid. And then we'll grab our prepaid. All right, and then we'll drag those across. And add a quick variance. And we'll just do AT&T as the variance because they are on top. All right, as we benchmark, several things jump out here. First of all, from a postpaid standpoint, they started out pretty comparable, but I'm seeing that over time, AT&T is actually rising relative to T-Mobile, and that's something that T-Mobile will want to watch out for. Maybe their pricing isn't staying competitive. Maybe there's a chance they could be doing better with postpaid devices, and the mix is changing. That's why we want to look at everything. And then for AT&T prepaid, we're seeing that AT&T prepaid actually falls significantly short of T-Mobile. So T-Mobile is doing much better on delivering prepaid, although they're falling a little bit short on postpaid. So there's things that both companies could learn, and this is where they want to start digging into the mix. This is where they want to start digging into their pricing strategies to see if there's any way to get more in parity with their competitors. T-Mobile would want to get more in parity with AT&T's postpaid, and then AT&T would want to get more in parity with T-Mobile's prepaid. What's really important here, I mentioned that mix could possibly be a component. All of these financial analysis techniques are designed to be used together, not necessarily in isolation. This is not anything you'd want to use one-off. You want to pull these together and learn best practices. Before we wrap up, I want to talk about some common pitfalls with financial analysis that I want you to watch out for. The first one is overlooking data quality. No matter who gave you data, never assume the data is quality. Check the data. If you have anything you can check it against, source systems or dashboards, check the data. No matter who gave it to you, even if it's your boss, never assume the data is quality. You don't know where it came from. Don't ignore the context, right? Numbers on a page do not tell the entire business story, and you want to go out and look for the context of the numbers and kind of understand what's happening. Don't cherry pick metrics, right? Don't come in knowing what story you want to tell. Analyze everything and then build your story. Otherwise, you're going to come in, you're going to select the things that either makes it look good, makes it look bad, but most of all justifies your story, and you don't want to do that. Next, don't overcomplicate, right? You could go into analysis paralysis, as we'll talk about in the bottom, and just keep analyzing and adding complexity and adding all these layers, and it's not necessarily going to help. There's a rapidly declining law of returns on this, and you don't want to go down that route. Ignoring qualitative factors, this is similar to ignoring context. You don't want to just look at the numbers. There's a lot of qualitative things happening in the business you want to consider. Correlations. Correlation does not equal causation. Just because something is correlated or connected doesn't mean it caused it. This is very important in the numbers, and you want to really understand your business and have a robust understanding of what's going on. And lastly, analysis paralysis. Decide when it's enough. Don't analyze endlessly forever. Stop once you have a good story, a good analysis. Get the work done. You do want your numbers to be perfect, but the rule here is good enough and move on, because again, the more time you spend on something, the less value you're adding to the company. If you found these tips helpful, make sure to give this video a thumbs up and let me know in the comments which technique you're most excited to implement. I read every single comment. Don't forget to subscribe and hit that notification bell for more unfiltered strategies coming your way every Monday. Thanks for watching, and I'll catch you in the next video. Until then, this is Mike signing off from F9 Finance. Cheers.